Hi, my name is Mitch Kramer, and joining me for the Fluent Financial November webinar is our head portfolio manager, Trey Talley. Since our last meeting, Trey has some very exciting news that he won't talk about, but I will. He got his CFA designation in less than 20% of people who undergo the program actually obtain it. It's a very, very difficult program, much more difficult than a law degree, a CPA or CFP. So we're very proud of Trey for that. And he's done a really good job this year with the portfolios. We'll talk more about that as we go through. This is a very interesting webinar. We've had a little pullback in the market since the end of October, and there is a technical term called the Hindenburg omen that showed up at the end of October, and we actually were positioning portfolios not to participate as much in the recent downfall. Trey, at what NASDAQ was down 5% since the end of October before today. I think it lost another 2+% today. Is that correct?
Correct. Big reversal today. Yep.
So, and a lot of it has to do with the overvalued tech sector and AI, and we'll go into that. So we'll go ahead and get started. First slide is the compliance side, and this slide basically states that the information being presented today is by myself and Trey and Fluent Financial, not private client services. So Trey, go ahead and tell us what we're going to be talking about today.
Yeah, thanks, Mitch. Hello, everyone. So since we last talked, the longest government shutdown in U.S. history has come to a close. So we've got the government back up and running, and we're starting to get some trickle of economic data. October, we're not really going to get much. Most of the agencies and bureaus were not sampling, so we're not going to get an October jobs report. It's really just going to kind of be a blip in history. And so the market is now starting to kind of worry maybe what kind of data we're going to get. Doesn't mean it's going to be bad. We did get a jobs report today. We'll talk about that later on. And some worries around this AI spend have started to percolate towards the surface, and the companies are starting to engage in things kind of like that we kind of saw at the tech bubble. Some of them circular financing, et cetera, and the market's kind of pushing back on some of the debt load and the huge capex spend that these companies are pushing out on. Nothing too ominous, but we'll talk about what's going on there. And the Fed has kind of trying to take away the punch bowl here from the party, maybe taking away the December rate cut. We'll talk about what's going on in rate cuts with the Fed as well.
Okay, fantastic. The first slide we want to talk about today, and this is kind of a extension of the webinar seminar we had last week on cybersecurity, and there were some topics that people brought up that I wanted to expand on. Most of the people on this call are retired or soon to be retired, and you have to protect your credit because the scammers and the people that want your money know that the retirees are the prime target because you guys control most of the wealth in this country. One of the things you can do is to put a security freeze on your credit report. And these are the three major reporting agencies in the country: Equifax, Experian, and TransUnion. And there's the contact information there. This next slide has to do with title theft. People taking your house or putting a mortgage on your house, it's paid off, and all of a sudden you're losing your house because someone took out all the equity. Well, there's a company that advertises on TV that says they can prevent this for you. It's about $200 a year. And you really don't need to use their service because most counties, and this is for Dallas County, you can go to their website, and we have the link here, and it says property fraud alert. You can click on this and put in your house, and they will automatically notify you if someone's trying to monkey with your deed and your title on your house. So these are just a couple of the follow-up items from our cybersecurity seminar. For those of you that were not able to attend, we had about 30 clients in person and a bunch of others online. We did post it to our YouTube channel and our website, and you can watch it. It'll be up there for 6 months. So I'll turn this back to Trey, and let's talk about the leading economic index that continues to deteriorate. It's now pushing into recession signal territory.
Yeah, thanks. So this leading economic index here, we're looking at the blue line on the chart. That's a 6-month rate of change. And this is kind of solidly negative, below 5% rate of change over this past 6 months by the self-imposed kind of recessionary signal that the conference board puts in there. We are kind of below that level. So we're kind of below this kind of warning recessionary signal there. We've been there since 2022, and we have not gotten a recession. So maybe we don't, but in the case of COVID, great financial crisis, and the tech bubble, we did. This is important, obviously, because the leading index can weaken before recessions. It can improve before new bull markets. Tends to coincide with kind of those market downturns. And it's useful to gauge risks and help us kind of position portfolios ahead of slowdowns or pickups. So we definitely want to pay attention to this. But the reading has really been quite weak since 2022 with very little improvement, and that's certainly the case today.
Yeah. And I think what's important is people that are on this call are on a regular basis. We've been talking about a coming recession. Is it a carrot on a stick? We don't know. The AI is added some different metrics to the mix, but as we go through the presentation today, things are looking a little more ominous. This next slide, Trey, kind of gives a breakdown of what components go into the LEI.
Right. So this index does not cherry pick. It's a composite of a broad array of data. It does pull in, things like stock prices and credit conditions. It pulls in stuff from the manufacturing sector. What is employment doing? Housing conditions as well. And so it's not, just focused on one area of the economy. They're trying to get a pulse, kind of a full picture view. There are, like credit has been okay for the most part. Stock prices is up, obviously, continue to set new highs. There's, a strong wealth effect that can empower spending. And so there are some, components there that have not been negative. But when we look at the economy, it's pretty clear there are sectors of the economy that are in recession. And you can, probably name them off as like, housing and manufacturing and trucking. Certainly, these are areas of the economy that have just had a very, very tough 3 years, and they have not recovered. Services sector has been holding in there, and then so far that's been enough to kind of keep us afloat here. And so that's kind of the glass half full.
Yeah. And I think what's really been important, people look at this and say, why are you telling this? Well, how does it impact me? And I think what you see here in this next chart shows the returns of the major indices year to date compared to our portfolio. So we've been investing your money with the backdrop of this dark cloud, and Trey and his team have done a really good job this year, especially in our more active managed portfolios, VNO, which is primarily stocks, ADVP, which is half VNO and half ADV. Stock income is basically a bond portfolio. It's up. The T-bond ladder has turned positive. So you don't see any red on the screen here. But I think what's been really interesting, Trey, you compare this to the indexes. The small cap index is not doing that well at 6.2. Dow's at 11. The equal weight S&P is 7. The overall index is about 15. And we're doing better than that in our indexes. But 40% of the S&P is 10 companies. We talked about that last week. International has done very well. We've had exposure to that as well. So I think we're well positioned, and we have taken more risk out of the portfolio in October, and we'll talk more about that in a minute. The next slide, people say, well, things are doing better and CPI is coming down, but why are things still so expensive? Bloomberg Business Week, we have a Bloomberg terminal, came out with this article recently, and they talk about the true living cost compared to the CPI index. And the TLC, it's not tender loving care, it's true living cost. In certain areas, it's been significantly higher than the CPI. And when you look at the green lines, which is the TLC, medical cost, housing has been significantly higher. Groceries are up a little bit. Transportation has actually been a little bit lower. And if you come over here, you look at expenses for the median earning two-parent, two-child household in 23, it shows increases in the lighter shaded areas of 50 to 100% since 2001. the medium shaded 100 to 200%, and then 200% is the dark shaded area. Again, what you're seeing medical and then housing, and the incomes haven't really kept up with these higher costs. The CPI numbers show that looks decent, 6% since 2001, but the TLC numbers actually show a -6%, and a lot of Americans are feeling this. Now, the majority of people on this call are definitely in the top 20% of Americans. This doesn't impact you guys as much, but your kids and grandkids are feeling this. And one of the big outcomes of the off-year elections was affordability is becoming the number one issue for both parties. And whoever does a better job in the next 12 months of dealing with that will probably, win the House of Representatives. And if they don't, it's the other party's going to do well. So this is a big problem facing our country, and we're going to have to deal with that. And one of the things that can help is the lowering of interest rates. And Trey, I know in our investment committee meeting on Monday, you were very frustrated with what Powell and the Fed is doing against this backdrop of negative information. They're not wanting to cut rates as quickly.
Yeah. So, coming out of October, the narrative kind of really shifted for the Fed, which was, we were all but assured 3 rate cuts to finish out the year and another 3 to 4 next year. We were going to get down to, 3% or below by, almost the summer of next year. And really for no reason, the Fed has kind of changed their mind, and they've kind of what we refer to as gone hawkish. And so, they were blaming it on, well, the government was shut down. We don't have the data. We're worried about inflation, and the labor market seems okay. We did get an inflation report, and we got 2 different reports from private employment reports, and they were all bad. The employment was bad, and the inflation was good. Everything that the Fed wants to see to cut rates. But Powell came out and drew a big line in the sand and said nothing is on the table for December. And so right now the betting odds right now they're shifting. Today they're actually down to about 40% chance that we're going to cut it. So there's a 60 to 70% chance that we're not going to get a rate cut in December there. That's kind of what that blue shaded area is showing you, is we're going to stay right at 4% to finish out the year. We will still get down to about 3.25 next year. But what the Fed is doing is they're trying to opt off their mandate for inflation, and the labor market's going to suffer. The employment is weak. Will it, rapidly deteriorate from here? We don't know. But what we can tell is that the Fed keeping rates, where they are and kind of slow walking the rate cuts is only going to exacerbate that weakness. So, they're probably going to be too late to the party, as they often are. They're probably going to have to cut further and faster because they're going to move us towards a recessionary kind of condition earlier on. But that's it was a big 180 that the Fed did over the past month or so. And I do think it's a mistake. I think that they should be cutting. Labor market is weak. We've got a lot of disinflation in the economy, and markets are starting to roll over, and that can have a bad outcome for holiday spending and year-end spending as well.
Yeah. So Trey, an area that we hear people talk about is what about private, credit, the alternative investment area. It seems like everyone's doing well there. Well, when you put this slide together today, it caught me off guard. I didn't realize that private credit and private equity are having some issues. And why is this important?
Yeah, so private credit and private equity, they're alternative investments. They are lending and investing, both debt and equity in the private markets. So you don't have to mark your books daily. The stock prices don't gyrate around. And for that illiquidity premium, you can get, sometimes higher returns. It does come with higher risk, no doubt. They'll tell you differently, but they're wrong. But some of these big asset managers, they do trade on stock exchanges. They're what we refer to as liquid alternatives. So they still do all this private credit and private equity, but you can actually buy stock on the company. What we've noticed really is that a lot of these asset managers are suffering deep declines. And it's not by accident, it's because their loans are underperforming, and their books that they're lending to are starting to deteriorate pretty quickly. The chart you're looking at is 5 different, some of the biggest asset managers out there in the PE and PC space. And these drawdowns range from, almost 30% down to 50%. And this has happened, these stocks were sitting at highs less than a year ago, and some of these companies have been cut in half. And so, we're starting to see anecdotal stories like Blackstone had a loan marked on their book at 100 cents on the dollar, and 30 days later, the company is bankrupt and it's marked at zero. No sliding scale, just an instant turn out the lights. You're starting to see these anecdotal stories come up. Investors are getting very worried. A lot of your big banks, JP Morgan, Bank of America, they don't have exposure to this. They're good, they're safe, and they're trading, near all-time highs. You've seen this huge divergence between the public and the private, asset manager space, and investors are starting to get worried. Is this a canary in the coal mine? We don't know. But what we do know, I think decidedly, is we can say that this is not a good, healthy sign. And this could have some spillover effects. It's not systemic, but this is something we need to kind of be observing here. The theme of private equity, private credit coming in was, we talked about it last month. There are more private equity companies than there are McDonald's here in the US. There's just been too many firms chasing too few opportunities. Valuations have gone through the roof, and returns on capital have compressed because of that. And I hope we're not starting to see the unwind of this. But this is something that is adding to the cautiousness of investors over the past 4 to 6 weeks.
Yeah, I think that's a very important point, Trey. And kind of an extension of this is the next slide is the credit spreads. And credit spreads, the higher, the bigger the spread, the more risk is, the more narrow the spread, the more safe it is. Right now, we're starting to see some widening in the spreads.
Right. So that top portion on the chart there, that's kind of your high yield credit spread there. That line, as that white line goes up, that means risks in the economy are getting elevated. And on the bottom portion, you're just seeing the S&P 500. Those should kind of move in opposite directions, where if there's more risk, stocks will sell off. And that's kind of what we're seeing here. So it corroborates what we're seeing in some of the private capital space. Which is, risks are rising and assets are starting to reprice to reflect that.
Yeah. And this next slide, it looks like an octopus. I've looked at it 2 or 3 times. I still don't understand what it means, but I think that's part of the problem.
Yeah, so this chart, if it's confusing and complex, it should be, because what we're looking at is a lot of the big hyperscalers and NVIDIA, which is kind of at the center of the pick and shovel of the AI race. And what we're seeing is just kind of all the different cross investments and deals and stuff like that you keep seeing in the news. And it's just kind of this intertangled web where it's so hard to keep track of. And we started, at first it was kind of, this was championed by the market, where we were seeing, good players circling the wagons, trying to invest and build the future of AI. And more, it just became kind of this game where you would just announce handshake deals just to get your stock price boosted. And so it started to ring familiarity with kind of what we saw in the tech bubble, which is kind of what they were referred to as circular financing. And so NVIDIA has made a lot of cash flow from the chips. They're at the top of the game there in competitive products. But what we're seeing is NVIDIA is taking a lot of that cash flow and investing it in companies that are ancillary or a part of their vertical stack. And those companies are getting kind of the wink, wink, from NVIDIA. Hey, we'll invest in you, but you need to come and buy our chips. And so it's kind of got this circular cash flow mechanism going, and it's not organic, fresh, new capital or revenue, which is what investors really want to see. So this kind of, again, added to some of the concerns that we're seeing here. OpenAI is a big part of this. They are obviously one of the leading AI models out there. They have about $1.4 trillion worth of spending commitments in these handshake deals ironed out over the next 5 years. But OpenAI is only at about a $13 billion annual run rate in revenue right now. If all goes well at the end of the year, they'll be close to 20. So investors are asking themselves, a company that makes $20 billion a year in revenue, how are you going to honor almost $1.5 trillion worth of spending commitments? People are starting to get concerned about this stuff. And I don't want to overemphasize this or ring any bells or raise alarms, but it's starting to feel like the market is no longer rewarding these companies for potentially over investing in this AI wave.
Well, Trey, I think we saw that today, because didn't NVIDIA have good earnings and the market responded favorably this morning? And I've been in meetings all day, but at the end of the day, I saw this big sell-off. So you want to expand upon that?
Yeah, so NVIDIA reported last night, and this morning we got a jobs report. If you'd have told me that NVIDIA was going to smash earnings and we were going to get a decent job report, I would have thought for sure the market would have been up. We could maybe start to, iron out the lows here. The market, both the NASDAQ and the S&P were up over 2%. The NASDAQ was closing in on about 2.3% this morning. And then around 10:30 our time, the market started heavily selling off and reversing. And so what the markets ended up down about 2% on the NASDAQ there, a 4% intraday reversal. We have not seen that type of volatility since the April tariffs scare. But this was a scenario where NVIDIA reported, they beat across, they guided margins higher. They were saying, to the nth time, demand is through the roof. Yet the stock finished in the red today. Semiconductors finished in the red today. A market that was up solidly 2% ended down 2% on the day. That was a big reversal. And I think a lot of people kind of jumped in on one side of the boat thinking that NVIDIA was going to help us get out of this little wobble we've had. And it just didn't, the market kind of did what it always does, which is kind of make fools of a lot of people at once. So big reversal, not a healthy tape right now.
Yeah. This next chart, I think, does a much better job of clarifying how bad this problem could be.
Yeah, so kind of as we wrap up kind of the AI conversation here, start to anyway, most of it's narratives. The math is hard, so most of the people aren't doing it right now. It's, the future is moving fast. I need to be invested today and then ask questions later. So this comes from GQG Partners. They're an asset manager, about 130 billion, and they've been very cautious on AI. They've been very cautious on AI since the beginning of the year, so they've been wrong. But they put some really good numbers out on a series of white papers that they produced. And so they're trying their best to quantify kind of the quagmire that we're here and prove that we're in a tech bubble, because some people will tell you we're not. Top left there, you're looking at AI revenues. And you're looking at, year over year and stuff like this. So what they're doing is they're adding up all of these AI models revenue. And I think it's important to note that as of July of this year, all of the AI models that you can think of, like OpenAI and Anthropic and xAI and all of these other companies, add up all the revenue, it's less than $20 billion. Okay. I mean, that's half of the revenue that NVIDIA is doing in one quarter, basically. So we're still very infantile on the money that these companies are producing. And they're collectively burning hundreds of billions of dollars in cash flow a year. Top right there, CapEx as a percentage of EBITDA. It's a alphabet soup. What this is measuring how businesses are investing into their business, capital expenditures. You can see a lot of the hyperscalers like Microsoft and Amazon and Alphabet and Meta, on and on. At the same levels as kind of those right two gold bars, which is kind of prior bubbles. A lot of investment, a lot of the cash flow that these companies are earning, getting poured right back into CapEx. And so that's looking at AT&T laying cable for the internet revolution. And you're looking at, Exxon, which was, obviously at the center of the shale revolution in the late, kind of 2010s, mid 2010s. Bottom left is kind of how they measure valuations. So price to sales, what they're trying to see is of the S&P 500, how many companies are trading at, strong, like overvalued price to sales ratios. At the tech bubble, we saw about 20%, 25% of companies in the S&P 500 trading at multiples above 10 on price to sales. Right now, that figures out 35%. So a third of the S&P 500 is trading at a multiple over a price to sales of 10. What that means is, if a company doesn't pay their suppliers, they don't pay their employees, they don't pay their debt holders, they need to repay every dollar that they own or that they earn to investors for 10 years in a row for you to get your money back. That's a big ask. Obviously, companies can't do that. That just puts into perspective how high these valuations are. And the bottom right is some people will say, well, yeah, it may be a bubble, but we're early on and we've got a long way to go. You're looking at just, prior bubbles that we can point to of the past 200 years, whether that's railways or the telecom or the shale revolution. And on the far right is the AI bubble. And then you can measure it from, 2020 or 2022, opinions differ. But this bubble has gone, over 500% at this point for these AI stocks. We have gone a long way. It doesn't mean that it stops here on a dime, but it does mean that we're overvalued. Companies are spending a lot of money. These AI companies are not earning a lot of money, and we need to kind of be aware that, if you want to keep dancing because you think that there are other songs, in the queue, that's fine. Just make sure you know where the chairs are when that music stops, because it is a bubble, and this can have bad consequences.
Yeah, and to expand upon that, those of you that have invested in the high-tech space with AI, NVIDIA, and some of the other companies mentioned here, we strongly recommend you install trailing stop losses to protect your gains, because if the bubble's bursting this week, protect the gains. I mean, I've been in this business long enough. There's a number of people that I talked with in the early aughts who had money in the telecom boom, Ericsson, WorldCom, and some of the other companies, and they were multimillionaires on paper. The next year, they were almost bankrupt. So here's AT&T and here's the telecom. When I saw this 593, this is a huge red flag, in my opinion, that you should be taking some gains off the table and protecting the gains that you have. Again, there's an old adage: pigs get fat, hogs get slaughtered. You don't want to be a hog. And what's interesting, this next slide, the market is pushing back in AI spending. Oracle, when they announced a deal with NVIDIA in October, it went up 43% in one day. And look, it's given all that back since then. But more importantly, Trey, I said, isn't a CDS a credit default swap? And he said, yeah. And I said, I haven't heard about credit default swaps really since the Great Recession, when they became commonplace. And why don't you explain to people what this means on Oracle's credit default swap?
Right. So Oracle's kind of at the center of some of the angst right now amongst investors. In September, they announced a deal of about $300 billion with OpenAI that would span over several years. And the stock jumped up over 40% in one day. And since that spike, what we've seen is Oracle completely retrace all of them and then some. And so that's reflecting investors' concern that they'd be able to finance or provide the CapEx through their cash flows to be able to honor these obligations. It seemed like investors are saying, were you just saying that to pump your stock, or are you serious? And so what we're seeing here is, like, in short, the equity side kind of celebrated the AI deal with a big move, but the credit side is now signaling increased risk. And the investors are starting to hedge, as kind of a concern of the large CapEx and the build out boom. This credit default swap that you're looking at is a 1-year protection on the bottom portion of the screen. That is, you can view this as the cost of insurance to insure against Oracle's, fold. So if Oracle goes under, how much does it cost to buy insurance today? And so right now, despite, Oracle announcing this big OpenAI deal, investors are more concerned that this deal could actually take them under than they were that the April tariffs were going to take Oracle under as well. So this has kind of raised a lot of concerns by investors. Like, how are you going to finance this? And this is the market's way of saying, if you're going to try and do this, the insurance cost is going to shoot through the roof, because the likelihood of you raising and spending $300 billion over the next few years is very slim. And if you try and do it, it might just cost you.
Yeah, I think it's very important. Let's expand out and look at the overall S&P number of stocks up and down. And what does this mean?
Yeah, so now we're getting to the good stuff. Markets. Why are they wobbling? What is going on? What we're looking at here is we're going to get 2 slides on breadth, market breadth. So as a pinpoint, markets are strongest when they're broad, and they are weakest when they're narrow. We want to see a lot of participation in markets. That's good and healthy. The chart you're looking at is the S&P 500, and the green bars are stocks that are up, and the red bars that are stocks that are down on the year. And so despite the market kind of, just getting off those recent highs, they're up double digits. Almost half the stocks are up and half of the stocks are down. That is incredibly rare. It's being increasingly led by a very narrow piece of the market. And it's being the concentration is pushing up the indice. It's always a worry sign. You don't want to act on it alone, but when it starts to, be a confluence of bad breadth, extended momentum, valuations are high, you start to pay attention. This bad breath culminated in something we call the Hindenburg omen. So the Hindenburg omen is it's kind of a rare market breadth signal that attempts to identify times when a stock market's internal strength is deteriorating beneath the surface. It's named after the dramatic, 1937 airship disaster. And so it reflects the idea that the market could be heading for turbulence. It's, it's looking at, new highs and new lows and, momentum beneath the surface. In other words, it signals that, investors are sharply divided. Some stocks are climbing while others are falling. And it often precedes periods of market stress. So historically, not every omen leads to a crash, but clusters of them have appeared before several notable corrections. And it does make it kind of a storm cloud warning rather than a precise forecast. And I want to emphasize, it's a caution flag. It is not a guarantee. It's looking at the health of the market and what generally happens after that. The chart you're looking at is the S&P 500, and those yellow dots are where you have gotten a Hindenburg omen signal. And so we've gotten about 57 of them over the past 3 decades. You can see that table set there, which kind of shows, the returns that you should expect. And that's why we don't want to put too much emphasis on it, is that, when we get these signals, a 4 to 7% drawdown is kind of what you expect in markets. About a third of the signals over this time period came with a drawdown that was over 10%. So that means that we can't ignore it. What we can kind of vector the data into 2 vectors. And so really, when you split it out and look since 2018, all of the recent signals, you see that the veracity picks up quite a lot. And so we've gotten 5 signals, not including the current one, since 2018. And the average drawdown, the median drawdown, ranges between 15 to 17%. And 80% of these signals have led to a decline of at least 10%. And so this is why we can't ignore it. So we want to balance it between it's a cautionary warning, but it's not a guarantee something bad is going to happen. The last one we got before October 29th of this year was right before the 2022 bear market decline. The one before that was right before COVID, about a month before COVID. We got one in 2019 that was a false signal. And we got one at the end of, right at the end of 2018 before that 20% decline, beginning of 2018 before that 12% decline. So we got this on October 29th. We were already in the process of selling some single stocks. We've had some good winners. It was time to part with them. They were getting a bit extended. Valuations were getting rich. We don't want to overstay our welcome. Got this signal that kind of accelerated our cash raise a little bit. So what we've done is we've kind of cleaned up the single stock names, took our profits. We tried to kind of rebalance that with some market beta, just to make sure we weren't sitting on too much cash. We don't want to jump the gun here on anything too ominous or anything like that. We really thought that we were going to get kind of a buyable dip here over the past week, and it just really hasn't. The tape has fought us the whole time, and the market just seems really weak here. There are a number of stocks rolling over, breaking down. Short-term trends right now are negative. So this Hindenburg omen, we don't really know what to make of it yet. We've gotten about that 5% decline that we'd expect. But if recent history is going to tell us what will happen, we could still have a further decline here. I think the important note here is we don't really know what's going to happen. We don't want to marry to any analysis. Don't try to be a hero. Don't try to pick bottoms here in the market or anything. Let the trend improve. Let the health come back to the market. And then that's where you can ride really good, safe risk returns. But for now, it's just something we want to bring about. It has been very informative for us. And so far, it is working. So we want to bring it up.
Yeah. Okay. Let's shift gears, Trey, talk a little bit about jobs. It looks like we got a decent job report, I guess, today. Or for September, we got a decent job report.
Yeah, we got the September jobs report today. This is trickling out from the government shutdown. Again, we won't get October's. We will get November's at about mid-December. Jobs report today was good. We got about 119,000 jobs created. There's a little bit of a reprieve because two of the three prior months we saw a contraction in jobs. So this kind of eased some investors' concerns around the labor market. We did get this report before the shutdown. We know October would have been bad just because of all the layoffs. And we don't know what November's will be yet. It was kind of overshadowed by a higher unemployment rate. Highest unemployment rate since August of 2021. We're up to 4.44 unrounding. So investors are starting to be concerned a little bit about the unemployment rate. The unemployment rate's important because it is how you can balance labor supply and labor demand. You know, we have immigrants leaving the country because of border control, and we have companies not really hiring as much because the economy's got a big question mark. If the unemployment is rising, that means that it's becoming lopsided and more people are unemployed versus employed. So this was in September before we would presumably move higher in October and maybe November. So that was kind of the sour note. So that did add to a little bit of the concerns by investors today.
And I think this ties back to the comments you made earlier, but where the Fed is arguing with the data that indicates they should be cutting rates. October will probably just be a black hole. We'll never get it because the government was shut down. And if you look at the trend from like 21 to now, the trend is negative. And Trey said, 2 of the last 4 months they've been negative. October will probably negative. November will probably be that way as well. And with the unemployment rate ticking up, that's not a good sign. So the Fed should be motivated to cut rates just based on this data. And with the CPI inflation numbers holding steady and coming down, that's another key metric for them. So for Powell to come out and want to keep rates steady, it doesn't make sense. And it's just unfortunate. So as we kind of wrap up, we have a new segment we want to cover. It's called Stock of the Month. And, Dollar General, it's been kind of a low retail place where a lot of people can find good values and good items to buy. Why do we like the stock?
Yeah, so they say there's always a bull market somewhere, and it's not always gloom. There are some good discounts out there, and so the one we're featuring this month is Dollar General. It's had a tough go since 2020, 2021, the CEO prior had left the company, and they were dealing with kind of a slow, low-end consumer. They kind of overextended on some stores, but now the story is reversing, and they're turning around, and things are improving, and the storm clouds are going behind them. And so they're gaining market share. The board reinstated their longtime CEO at the end of 2023, whose mantra was kind of back to basics. Let's get back to the game plan here. They're executing on a number of new stores, increasing low single digits there. So it's good expansion for them. They wouldn't be doing that if future business was not good. And their margins have stabilized. Free cash flow and earnings are starting to turn around and improve. The valuations are really cheap on this stock. They're trading below market multiples here. The stock is kind of, the trends have flipped. You can see that in the chart there, short and long term, looking healthier, kind of a nice pullback into support here. Maybe a logical entry. Something we have in a couple of the portfolios. Just keep an eye on it there. But I think this is a good low value, higher growth type of play that you can find in kind of even a weak tape here.
Yeah, well, yeah, thank you for that, Trey. Last slide just shows the income generation from our covered call portfolios. This is what we tell you guys will produce in the income on $1 million. This is trailing 12 months. And again, this is yield, it's not return. But the portfolios are doing what we want them to do. Probably some of the biggest changes in all 3 of these portfolios because of this kind of negative backdrop. You will see some bond holdings in there. In stock income, we're not using 100% individual stocks. You see bond ETFs in there. You see some other indexes, but we're still producing the income that we need, and we're getting some growth out of that particular portfolio. So with that, we'll open this up for questions. I'll go ahead and stop the recording and see if people have any questions.